What's going on, everybody? Welcome back to my YouTube channel. So for today's lesson, we're going to talk about a very hot topic: stop hunts. Now, the whole reason behind me talking about this is because I'm getting a lot of messages from traders saying to me, Rox, how do you avoid them? So today's lesson will be on 3 ways to avoid avoidable stop hunts. Let's roll the intro. So it goes without saying that a lot of traders talk about being stopped out and then seeing the market go in their direction. I entered a trade, I placed my entry, I placed my stop loss, I placed my target, and then the trade took me out and then accelerated in my direction. And then they start to blame the market makers, the banks, the institutions, the brokers, and what have you. Now, the truth is it can be very frustrating being stopped out and then seeing the market rallying a direction. But the question today is, can you avoid it? And the honest answer is, no, you can't. But can you put measures into place to avoid the avoidable stop hunts? Well, absolutely. And that's what today's lesson is on. I'm going to be sharing with you 3 tips and 3 examples that you can start applying to your trading today so that you can make sure that when you enter those trades, they go in your direction. Now, before I share the first example with you, I just want you all to understand that the majority of this process is mindset, and the mindset of thinking every trade should win is what's really going to hold you back. That FOMO to want to jump into trades, anticipate trades, and just take trades that you shouldn't be taking, that you normally would or should be taking. So let's take a look at example number 1. Here we see USD CAD on the 15-minute time frame. This is our entry time frame. Now, the structure of this market is clearly pushing to the downside. So let me just do something here. So we have a very nice clean slate. What we're looking for in this market structure is for sells. We're not taking sells in a push phase. We're waiting for the market to pull back and then continue to the downside. So what we're looking for the market to do is create an exhaustion, as you all know it to be. And we're looking for the market to come back into some sort of key level. For this example, let's trade like the majority of traders, and let's draw this level in and say, well, we have 2 wick rejections here where the market is paused. We have a push phase, a slight exhaustion before a continuation down. And now that we have this strong lower low, we're looking for this pullback. So this sort of U-shaped, V-shaped formation, and then price to come back to a key level. Now, I'm going to slow this down when I edit the video so that you can see this very clearly. But the first tip today is wait for a candle close in your direction. Never anticipate. So if you're planning to sell this market structure, what you're looking to see or waiting for is for a bearish candle close in the direction of this trend, which is down. Now you can see here, when I press this next candle, look very closely. You see how that candle went bearish, leaving a slight wick at the top before it went bullish? This is what most retail traders will do, or the majority of traders that are finding themselves getting into a lot of stop hunts. They will see that candle pushing bearish, they will press instant execution because they want to get into this trade, and then the market will go against them. So let's say we did enter that trade based on anticipation. We didn't wait for the candle to close, and we just jumped in on impulse. So let's say we go for 7.5 pip stop loss here. We're in this trade, we're not yet stopped out, but we entered down here with an instant execution, and we go for a 1-to-3 risk reward ratio trade. Now this falls out of line with our first tip, which is wait for a candle close in your direction and never anticipate. But we did, we've done that. So we press the next candle and look what happens. Now, is this a stop hunt? Is this the market makers? Is this the bank? Is this institutions? Is this the brokers? Or is this you just anticipating that the market should just go down because you want it to go down? It's something to think about. So you get stopped out of this trade now, you blame the banks, you blame the institutions and whoever else you blame, and now you're 1 hour down. But if you just waited patiently, just 15, 20 minutes more, to wait for price to create a candle reaction in your direction, you see this strong bullish push to the upside, a beautiful wick rejection, and a bearish body. You take the trade. Now, most traders wouldn't be jumping in now because they'll probably be banging their heads against the wall, running around the house, or pop their phone back in their pocket and be like, screw this. I don't want to trade Forex anymore. I constantly get stopped out. Whereas the patient traders are still sitting here, twiddling their fingers, waiting for this formation to build up, and then they take the trade. So now we have a confluence. Pin bar, bearish body, downtrend, pullback, key level, rejection, and you take the trade. And look here. Be nice if you close below it. But anyway, you get the point. There you go. You see this? Absolutely gorgeous. So tip number one, wait for a candle closing your direction and never anticipate the market to go in the direction you want it to go until it gives you the confluence you need to take the trade. Let's move on to example number two. So for example number two, or tip number two, we're going to be looking at Aussie dollar JPY. We can clearly see the market structure is pushing to the upside, but if we look slightly to the left, what can we see? We can see a major reaction at a major level in the market where prices created a high and then rallied from it, and prices come back to that level, created signs of multiple wick rejections before then pushing to the downside. Now, at this stage, what most traders are doing is they're looking at this and they're saying to themselves, oh my goodness, I've missed this trade. It's going to the downside. I've missed the best entry. I should have got in here at this pin bar, would have had a good stop loss, good risk to reward ratio, stop loss above this level. And all of that starts to build up in their heads. So they wait and they wait and they wait. And then they realize that they've missed this trade. Oh my goodness, it's still going down. And what do? They decide to jump into this trade. They place their stop loss and then they set their target. And in the back of their heads, they're just saying to themselves, well, look, if it was going to go down here, it's going to go down here. We've created a new lower high formation. As you can clearly see, the market has created a high, push, lower, higher, and now I want it to go down. Now look where the stop loss is. It's above the higher low. But is this a good trade? Well, tip number two is don't take trades that are not at your key levels. So if you have seen that price reacts to this major high, then what are you doing with this trade? You're taking the trade in theory in the middle of nowhere. It looks good as a lower high, but it certainly is not a good trade. Because in theory, price is allowed to come back to this key level as often as it wants before it decides that it wants to go down and continue this downtrend or potential reversal. So if you're trading like this, what are you doing? Well, you're taking a trade that's not at your key level. You're anticipating that the market should go in your direction again, and you take the trade, and then, okay, you're moving your direction a slight bit, pin bar, so you start to build up faith that it's going to go down, and then eventually, what happens? You get stopped out. Now, is this the banks? Is this the institutions? Is this the brokers? Is this the whatever you think it is? Market makers? Well, no. You just didn't follow your rule, which is take your trades at the key levels. So you get stopped out. Now, prices come back to this key level again. You can see a beautiful pin bar. You don't see the body yet, so just wait patiently. Another reaction at this key level where price is holding, and then eventually you get a candle in the direction you wish to take the trade. Now, what can you do? You can place your stop loss above this key level, and then you can target your 1 to 3 risk reward ratio trade. The confluence on this trade is key level, pin bars, price reacting, failing to break above, candle in your direction. You take the trade, and what happens? You hit take profit. And guess what? This trade is gorgeous. Okay? So tip number two, do not take trades that are not at your key level. Don't anticipate, don't build up a story, don't become a storyteller as most traders are. Just wait patiently for the market to come back. Don't blame the market makers, banks, institutions, brokers, or whatever you're doing. Sometimes it is your fault. Let's take a look at our final example and tip number three. For our final example, we're going to look at pound USD, and this is tip number three, and in my opinion, it's my favorite one. We can clearly see the market structure is to the upside. We can see that prices create some sort of higher low formation here. This was a previous higher low. This is a push. This is the pullback, and you can see price is doing whatever it wants to do. So let's say you want to take a trade at this level, but you're looking for those wick rejections and you're looking for a candle in your direction. and you just wait and wait and wait, and then guess what happens? You just don't get what you need to take this trade. Then eventually you see price starting to push up and you say to yourself, oh my goodness, I'm going to miss this trade. Look, it's away from my key level. I understand that, but it's a pin bar and this should in theory just keep going up. Well, tip number 3 is don't try to cheat the markets. And what do I mean by that? Well, you know where the key level is. So what most traders are going to do is see this and think to themselves, well, if I place a stop loss here, it's too big. I see the pin bar. In theory, it should stay below this pin bar. So let's take the trade with an entry that looks something like this. Now, in theory, you're cheating the market. Let's be brutally honest. You're cheating the market because, as we've seen on our second example on Aussie dollar JPY, price is allowed to come back to this key level whenever it wants before it starts to rally up. So when you take this trade, is this trade safe? Or are you trying to cheat the markets? You are basically, just like on the last 2 examples, saying to yourself, if I take this trade, it should go up. But remember the mindset that we spoke about in the beginning. Don't think that every trade should win just because you've taken it. So you take this trade, looking half decent. Okay, it's hovering around. Oh, it pushes to the upside. Oh, and then look what happens, guys. The market comes back down, stops you out, and you start to blame the brokers, institutions, banks, what's the other one? The market makers and everything else. But did you take the trade at the key level? Did you wait for that candle to be in the direction you want to take that trade? And was your stop loss in a safe place? Below the higher low? No, it wasn't. So let's go back to that example and let's take a look at it one last time. If you plan to take a trade like this, what should you be doing? Well, this is what you should be doing. The candle is pushing in your direction. The candle is bullish, and there is enough evidence to support that this should go up. Granted, you're not at the key level, but what can you do? You simply just place your stop loss below the key level. Yes, your stop loss range increases, and yes, your take profit range increases, but it's better to be in a winning trade than it is to keep losing trades prematurely and see the market going your direction. So remember our first example where we cheated the market? Let's take a look at our second example. And there you have it. Absolutely gorgeous. So I hope these 3 tips will be useful to you. Just remember, wait for a candle to close in your direction. Never anticipate. Don't take trades that are not at your key level. And the final, and to me the most important, don't try to cheat the markets. As I always say, if you've enjoyed this video, please smash that like button, subscribe, and until next time, take care.